At BMO ETFs, all our investment tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we build solutions for the Canadian investor. So next time you invest, consider a Z instead.
Hey everybody, it's the King of Hearts coming to you live from Toronto, Canada. Anyways, happy Mother's Day to all out there. It's a great weekend. I always love this part of the year. One, because I'm a golf fan and you can find me on the golf course most days, but in particular, a Go Leafs Go. I struggled with what shirt to wear for this. I was going to put my Leaf shirt on, probably should have, but a special thank you to my wonderful wife, who has been a wonderful mother and partner for 35 years now. We're very soon going to celebrate that long-term anniversary. And so with that in mind, markets are markets, and let's dive into the chart room. I've got a couple of things to look at this week to see if we've learned anything. Thorsten Slouck, I've been talking a little bit about him recently. I'm really enjoying his daily notes. You can subscribe to them. He's the chief economist at Apollo, private equity, private credit firm. Put out a webinar today, and you can grab the slides off their website. Thought this was kind of interesting as the timeline. So April 2nd, Liberation Day. But a week later, they rolled a lot of that back. But with the massive amount of tariffs and this weekend's discussions with China, see how well they go. I suspect China knows the U.S. is on their back foot here and don't have the negotiating power that perhaps the administration thinks they do. So we'll see how that goes. But I think China is going to play hardball with us, and we might come in Monday morning and the equity markets may not be happy. So we'll see how that plays out. But in this graphic, he outlines a time frame where the container ships aren't bringing product anymore, and it's only a matter of time before some of the shelves are empty and that we start to see layoffs in trucking and retail. So I thought that was very interesting, and this would be a good idea to start looking at the trucking stocks and the retail stocks to see if they're giving us a message that would suggest this forecast is going to come to fruition. So let's have a look into the chart room and see what we learn. President Trump posted a lot of things on social media this week, and I honestly believe he's got guys there trading this stuff for him because his posts absolutely move markets, and you can see the algo response to parsing the headlines and have the market rip higher and correct off negative headlines. I don't know, 7 a.m. on Friday morning, we saw a post on social media where he basically said, maybe the 80% tariff rate is right. Maybe we'll roll it back from 145, but really, Scott, it's up to you. Referring to Scott Bessent, who's going to be negotiating or taking the meeting along with Greer in Switzerland with China this weekend. So you saw some others speak out on Friday in the afternoon, some positives, some negatives. Overall, which was interesting, especially given the event risk of the first meeting with China this weekend, that Friday's price action was the most narrowest trading day in 10 weeks. Interesting statistic. Not many may have picked up on it. So this week we popped above 5,700, reversed back into the range, kind of looks a bit like a failed breakout. What happens with China over the weekend probably dictates the next 5% on markets. So if somehow there's great headlines, they've made big progress, China confirms that, they're heading towards a deal, markets probably gap open Monday mornings and rip through the 200-day average and squeeze a bunch of people back into the market. So one scenario, not my preferred scenario. More likely, China plays hardball, and nothing gets done, and really there's no good announcements. And if the White House says something, China probably says something different. So we'll see, Sunday night, Monday morning, how that plays out. But I would argue 5% lower before 5% higher at around 5,700, 5,650 on the S&P is my bet. 10% higher back to the old highs, 10% lower back towards the old lows. That to me requires significant economic decline, i.e. Thorsten Slouck's recession scenario starting to play out in the next few months, and no progress. We get to the 90-day window beyond a nonsense agreement with the UK, where the US has a trade surplus last year, is ridiculous. We learned absolutely nothing at all from that, yet markets celebrated it, and possibly why we fell back into the range, because there was no meat on the bone there. So China this weekend will be very big. I have no insights whatsoever on how that's going to go, but if I had to flip a coin and tilt it one way or the other, I tilt it slightly towards the negative, but only slightly, because it's so hard to predict the White House and what's coming there. And part of Trump's style is to keep everyone off balance, including me. So when we look at the rails index, the transport index overall for the broad S&P 1500, SPR index, the broad 1500 overall, and the retailers, XRT ETF, we can see the weakness in the retail stocks, head and shoulders above the weakness in the broad 1500 composite, where the transports are in line or slightly weaker than the market overall. So, what's affecting trade in the consumer is relatively weaker, but it's not dramatically weaker. And that's an important kind of message. So, markets have bounced and recovered. We're not back on a broad market basis. We're closer to the April 2nd level, but when it comes to the things that are more tariff impacted, the consumer was already weakening well before that, largely on tariffs and the expense coming to the consumer. I saw a headline on Friday that, don't worry, not all the expense of tariffs are going to get passed through. Companies are going to absorb that in the profit margins. Well, clearly earnings and earnings outlooks aren't reflecting that, because generally speaking, for the broad US market, still expecting 7 or 8% earnings growth this year, which to me doesn't add up. So, you've got the bond market sending you a message too, that if we were going to go into a harder economic landing, we should probably see more of a bid in the long end, and we're not. So why are we in this 5-year long bear market for rates? JGBs are breaking out in terms of yield to the upside. We're just not seeing that reaction on the bond side. And, that to me cements the idea of at a very minimum, we're in a range bound market for the long end of treasuries, so that even if we do get a hard landing, I'm not sure the long end is going to be able to rally much. Why? We've got this $5 trillion continuing resolution budget deal that, we're coming up on the deadline sometime in July or June. I think when pressed, this week, Besant in front of Congress, and I think it was Elizabeth Warren on the senator side, that basically, he wouldn't cop to a date where they're out of money. Anyways, we're in a rock and a hard place here, and it's going to be a challenge. Are they going to tax treasury issuance to foreign holders? Is that going to be part of the negotiating chip? We'll get some headlines this weekend, but if those headlines aren't supportive, at least a little bit, then this market's in for another big chunk on the downside. So that's the bigger risk in front of us here, as opposed to, I think, worrying about the market breaking out on the upside. But believe me, Trump is going to try to post a social media push to the upside with all the good news that he claims is coming in these trade deals. For now, the algo seems to be believing him. We'll see how it ultimately plays out. Have a great weekend, everybody. Have a wonderful Mother's Day. And we'll see you next week.